In this video, we're going to take a look at what I think is one of the most powerful strategies when it comes to trading foreign exchange. Hello, I'm David Jones from Capital.com, and this is the latest episode of our course on trading Forex. Last time around, we were looking at the idea of buying near support. This time, it's a follow-on from that, so if you haven't watched that video, watch that one. We're now going to look at the flip side, and that's selling a market near resistance. So let's get into it. Let's have a look at a quick example, then we'll look at the theory, then we'll look at some more real-world examples. Let's just take a quick look at what we mean when we're talking about selling near resistance. It's this sort of thing. This is a pound against the dollar. We can see April the 3rd, the market has rallied from about 130.20 up to as high as almost 132.00 the 3rd of April. Sells off a bit, so it sells off actually about 50-60 points, and then a day later runs back up towards this previous high, runs out of steam, and then sells off deeper. But let's take a look at this in a bit more detail first, then we'll look at more real-world examples. So let's look in a little bit more detail at this idea of resistance and how it gets formed. So put simply, in its simplest form, it's a previous high, a level the market has risen to and then fallen back. So it's a price point the market cannot get through. For example, if a market is trading at 900, then it rallies to 1,000, but then slides back to 900, clearly the sentiment changed at 1,000. At 1,000, the market was perceived as expensive. The selling power that came in overcame that previous positive momentum. So the assumption is that levels that were important in the market in the past will be important again in the future. So how can you use this as a trader? It gives you an obvious zone to watch for an entry point when selling short. More importantly, if you're trading using this approach, then it's clear where the stop loss should be set, rather than just choosing a random figure out of the air. You've got a definite point that if that level gets broken, then your idea for the trade is probably no longer valid. Let's start off with a bigger picture example first of all. This is dollar Japanese yen. The period I'm looking at, this is November 2018. You can see it traded as high, it's about 114.20, and then sells off almost a couple of hundred points over the next slightly more than a week or so, then comes back up, rallies back up. But you can already see on this day here we're seeing something of a turnaround. So the question is it failing near resistance? There's really no way of knowing. We have seen the market probe higher but hasn't managed to break through, so it could be one opportunity to sell short. We've got an obvious level for the stop above the highs, those 114.21 highs from a couple of weeks earlier. The market's trading at 113.56, so we have an area where the market has started to turn around. We've seen a down candle. We have an obvious level for the stop. Let's walk forwards and see what happens next. So the move does take a few days to unroll. It sold off the next day, pushes back up just in case we missed the opportunity there, and then sells off much more heavily over the next sort of 5 to 7 days. So here's an example where the previous resistance, entering short, selling dollar yen with stops above that level, turned out to be a good trade. A bit of a shorter term example this time. This is the dollar Swiss franc. We're looking at the first week of March from 2019. So the dollar has had a good run of strength up to just above where are we? 101.12, 40 to 50, that sort of area. The market does sell off, but then rallies back up. So it's a similar setup to the dollar yen one we just looked at, but on a shorter term time frame, because these are hourly candles. So we've seen the market try to push higher and turn around during this hour. So again, one strategy would be selling into here with a stop loss above that recent high. Let's see what happened next. Again, it takes a bit of time to get going. Over the next 10-15 hours or so, it drifted lower, then pushed back up, not quite getting back to that high, and over the next couple of days the weakness really came in. So again, a good risk reward trade. If we're going short here with stop losses above, we have potential profit a multiple of our initial risks, but again just selling ahead of this previous clear resistance. And just to show this doesn't work all the time, obviously, here's a short-term example. This is Euro US dollar from April the 9th. We're now looking at 5-minute charts, so much shorter. So the market had pushed as high as 112.72. Sells off, only sells off about 10 points, pushes back up again, and we have some weakness coming in on the 5-minute chart. So we may think about selling short here at 112.67 with stops somewhere above that level. Again, let's jump forwards. Over the next 20 minutes, the market rallies, pushes briefly through that resistance, but hasn't managed to close above. So arguably the trade is still on. It's still struggling with this 112.72 level. Let's jump forwards again. But then we have a more decisive break and the market does trade higher. So as an example here, just to illustrate, it's not right 100% of the time. It's important to have stop losses to manage the risk. But when it does work, it can stack up interesting risk versus reward opportunities. So there you have it. Like anything, it doesn't work all the time. But I think the important thing here is the fact you have a clear point to get in. You have a clear point when you're wrong to bail out of the trade. And it does set up some excellent trade potential in terms of your risk versus what your potential reward is. So the risk reward, I think, on these sort of trades are very attractive. We'll start wrapping things up there. As usual, if you have any questions or a different view, leave us a message in the comments down below. If you like the video, please click on the thumbs up. It helps us reach a wider audience. And to never miss out the content we produce, the next step of our trading course, the various market commentaries as well, just make sure you're subscribed to the channel by clicking on subscribe, and the alarm bell notification means you get a push message every time we upload new content. But for this latest stage of our trading course, we'll leave it there. So from me, David Jones, and Capital.com, good luck with your trading.